Thank you so much for joining us on Morning Markets. This is the first pass that investors have to think about U.S. job growth as we look ahead to a week of key economic and earnings data. Jobs slowing at the, or job hiring, I should say, at the slowest pace that we've seen since the beginning of January 2021. We're going to get a key read of inflation. We are expecting the headline number to tick meaningfully lower, but of course we will be looking at some of the core angles of that. And of course, we're going to get bank earnings to give us a sense of where the economy goes from here. Our next guest says, when you look at the slowdown that we are seeing, the Fed really should be pausing here. Let's bring in Claudia Sahm, former U.S. Federal Reserve economist and founder of Sahm Consulting. Claudia, thank you so much for joining us this morning. Let's talk about this picture of economic data that is coming through, and it's starting to roll over. You know, the growth numbers are not as robust, not as resilient. Why do you think this means the Fed should pause here?
The Fed has done a lot. They've raised interest rates at a very fast pace through the last year. It's time to hit pause and be patient to have it work through the economy. And we see signs that it is. As you were saying, job growth has started to moderate. It looks a lot more like before COVID. Wage growth, the same thing. We've seen a lot of the work that the Fed has done, and the recovery has been fast. It's slowing down. The Fed should slow down. It should hit pause.
And with that in mind, one of the things, of course, that could keep them on the sidelines is inflation. And so many people torture the data, I think, to confirm the narrative that they have going into the data. You can look at it and see, oh, inflation is cooling, or you can look at it and see, no, there's some parts that are remaining stubborn or even going higher. How are you slicing and dicing the inflation side of things?
It's absolutely true. There is something for anyone in every single data release we get. At this point, we're in this together, and we have got to take a bigger picture view. We've got to see what's coming. Consumer price inflation is one of the last places that the Fed's actions show up. It has to work its way through the economy. I am deeply concerned that there will be a lot of overreaction to the inflation data. Frankly, whatever it is. And if the Fed keeps going, they risk doing too much. And they may already have done too much, particularly with the banking turmoil. But we can't get obsessed about one number. That could cost us a recession or not.
Do you think that's what they're doing?
I was trained at the Federal Reserve. I fully believe the staff, the governors, the officials, they know it's one number. Now, they have been burned really bad by inflation, and it is part of their dual mandate. I think they'll look at the jobs report in a positive way on Friday. Not all the markets have, in terms of how much more they need to do. I worry that an inflation print that's not a good one could push them to the 25 basis points. But we'll see. It's their call.
It's one thing to call for a pause, even if that pause is after, say, just one more 25 basis point hike. It's another to call for a cut, and that's also what the market is pricing in. So as you call for a pause, are you also looking for a cut later this year?
No. The Federal Reserve, even if a recession comes, they are going to stick to it. I mean, there are precedents in the past. They really are into the 1970s and 80s with Volcker. There are precedents in the past that if you pull up too soon when there's a threat of a recession, inflation gets even more embedded. It makes it even harder. We don't live in the 1970s. It's 2023, last time I checked my calendar. And yet, this is so ingrained in the Fed's psyche. Like, I take them at their word that until inflation really starts moving down in a very substantial way, they're keeping it through the end of the year. I think markets are wrong about that.
So then I really find it difficult to see this kind of short and shallow recession if the economy is rolling over and the Fed is not going to be at your back this time.
Yeah, I'm worried too. I up until the last meeting when they raised 25 basis points in a banking crisis, I still was in the softish landing case. That's no longer my base case. I mean, we've really put a lot of disruption into the banking sector, and that will feed its way through. The path to no recession or a mild recession is this labor market better be as strong as the Federal Reserve has been complaining for months, because consumers and workers might be able to buffer this, but we should not have rolled the dice on this. This is bad policy.
And so then what is your base case now?
A recession.
I guess I don't know. I guess when you're saying it's not going to be short, shallow, it sounds like you're looking for something more severe than perhaps the average investor is prepared for.
Is that my base case, a severe recession? To me, it was a real wake-up call with Silicon Valley Bank and some of the other bank failures, Credit Suisse, that we have the Federal Reserve, with its fast and big interest rate increases, has caused a lot of fragility in the financial system. To get a severe recession, something has to blow up. That was a reminder, things can blow up. That one got under control largely, but we are at a risk of something bad. So to me, that's the severe recession, but I'm not forecasting some kind of something again like Silicon Valley Bank, but it could happen. But even a mild recession is millions of people losing their jobs, right? This is not good.
That's right.